Council come to order, please. This evening we start with an informational presentation from Phoenix Advisors. Matt?
Yes, thank you very much.
The floor is yours.
I'm Matt Sperndel from Phoenix Advisors. We're the city's...
Do you have your mic on?
yeah, I have this mic in my pocket. Is that working? Yeah?
We'll see.
Okay. So let me know if it is.
That's better.
Mm-hmm.
Okay, so we'll keep it like that. Maybe it'll go like this. We are is the financial advisor or municipal advisor for the city. I was asked to come in and give a semi-informal presentation with respect to the bonding process that is done as we issue and borrow money for capital projects. So kind of a little bit about the process, and then also some more specifics about the city and the city's credit rating, and those types of things, the factors that go into it. So we're going to talk a little bit first about the process, and then we'll get more into Norwich specifically in terms of the credit and the most recent bond sale we did. So if anyone has any questions or anything, just feel free to interrupt me. Okay. So just a little blurb on who we are is we're a municipal advisory firm that has been open since 2004. I opened the Connecticut office in 2008, and you can see some of the statistics that we work with school districts, cities, issuers, fire districts, state government authorities in Connecticut, New Jersey, and some in Pennsylvania. So that's just a little bit about us. Now, in terms of the bond issuance process, it is, before the issuance actually gets started, there's a process that goes into, what we're going to do in terms of a plan. So what normally we'll do is, working very closely with the town's finance department and the town manager or mayor, depending on the issuer, is we identify capital projects, obviously that need funding. We assemble the finance team, which is obviously us, the finance department, bond counsel that gets involved, obviously, paying agent, there could be underwriting banks and so on involved as well. Obviously, we make sure that all the resolutions are in place. Obviously, legally, that's something that we have to do, and that bond counsel obviously has a big role in that. How are we going to fund the project? Is it going to be with bonds, with notes, with cash, with grants, some combination thereof, which is typically the case. Developing a financing plan, a timetable for the issuance. Usually, that's about a 3-month process from start to finish to actually get the funding. We look at long-term versus short-term financing, so short-term being a ban or bond anticipation note versus locking in for a 20-year period with a bond issue, which would be long-term. And we look at your obviously existing debt service, what the budget and mill rate impacts might be when you go and do the bond issue, and make sure that fits into some of the budget constraints and things like that. And also keeping in mind the future needs of the town. So if there's a bigger project coming up 2 or 3 years down the road, making sure we structure that so that there's not as much of an impact if we possibly can do that. So continued, of course, during the process, we need to get a rating on the bonds, obviously. Since if you are issuing bonds, investors want a rating, and they'll want that rating from either Moody's, Fitch, or S&P, some combination thereof. And we can work with the town to determine which the best course of action would be with that particular decision. It obviously directly impacts your cost of borrowing. So the higher your rating, AAA being the highest, the lowest your cost of borrowing, because it's considered the safest. So you can see the continuum there. AAA, AA plus. The AA is in blue because that's the city's rating from Standard & Poor's. And then it goes down single A, triple B. Then it goes down under investment grade, and that's when you get into, the Hartfords and those kinds of situations. So I'm not going to go there. Effective presentations. What we do is we try to uncover all the items that the rating agencies are going to be interested in. Those are trend and comparative analyses, which we have some in that presentation a little bit later on the comparative side. Looking at the tax base in terms of developments, new growth, future growth, revaluations, Obviously, fund balance, operating results, your debt ratios, and what policies you have in place. There's a lot of different criteria that go into this, but those are just some of the things that we would incorporate into the presentation to make sure that it's effective and it's comprehensive, and it really gives a full picture to the rating analysts on the other side of the phone so that they can go to their committee with the full spectrum of knowledge for on the issuer. So what else goes into it? This is a big part of the process is the official statement, which some of you may or may not be familiar with. That's the cover page from the last OS that we did, which is from the end of last year. And you may have seen these, but this is the copy of the actual issue that we did with the city of Norwich. So there's a lot of this is a financial report, sort of the back end of it, and then all this other information we help put together with the finance department. And it really just has all the information that an investor would need. If you're looking at potentially investing in the city of Norwich, again, everything from management, description of the issuer, economic factors, the terms of the debt, what the nature of the security, is it general obligation, is it revenue-based, those types of things would be in there. Where the proceeds of the issue are going, the capital plan, financial data, and pension and OPEB long-term liability data. So really, a lot of things that are already in your financial report, but just presented somewhat differently with more historical, a lot of historical trend information, but also pro forma based on that particular issue and what impact that's going to have on a lot of your ratios. Since your audit report, for June 30th, for instance, of 19, would have just come out, and if we did an issue 6 months from now, that data a lot of times is already kind of stale. So the official statement is an opportunity to sort of bring everything up to the current time frame. So that's all necessary. Method of sale, do we do competitive versus negotiated? Competitive is when we say, at 11 o'clock next week, put in your best bid and low bid wins. Negotiated would be something more complicated that might have some more moving parts that we might need to engage an underwriter ahead of time so that we can have the opportunity to explain the deal, what's going on. If the credit's really bad or it's a really small issue or there's some other explanation. In your case, they're competitive. It's solid credit, good size, so we've done it competitively. Are those bonds going to have a call feature so that you can redeem those at some point in the future? If rates go down, that's the redemption provisions, and 99% of bonds do have redemption provisions. And then, of course, we distribute the offering documents, the official statement, and the notice of sale to every potential bidder investor that could potentially be interested in buying the city's bonds. So getting maximum marketability, making sure a lot of people see it to ensure that you get a low rate. And then just in terms of timing, what are interest rates doing at that particular time? Is there competition in the market? Are there other deals coming, that day or that week? Economic releases with Fed funds and the FOMC meetings, those kinds of things, and wherever holidays might fall, we want to stay away from those. And just we obviously have to coordinate the financing team to make sure that everybody's on the same page and we stick to the same schedule. Okay. So when we actually hold the bond sale, when we get those 6 or 7 bids in from Roosevelt and Cross and Robert Baird and Raymond James, we have to evaluate to make sure that all the parameters and the specifications of the bids are accurate and within the regulation of what's laid out in the notice of sale. We make a formal award based on that lowest true interest cost to the town or city. And then once it's done, we obviously get the acceptance from the issuer, and we distribute the sale results out to the market, to let them know that, Piper Jaffray won the city's issue. So it goes out on the Bloomberg wire, and then we begin the closing process with the paying agent, DTC, the bidder, and where's the money going on that day, a week or 10 days from the sale to when the funds actually change hands and the bonds and the notes or notes are actually released to the winning bidder. And then there's obviously document signing, a lot of signing that goes on after that. Okay. After the issuance is done, we develop the schedules, obviously, for the issuer in terms of, here's your 20 years of of debt payments. We work that into your overall picture too, so we can see kind of where things fall out and what, future budgets are going to need as a requirement for debt service. There's a lot of continuing disclosure requirements, particularly with new SEC regs in terms of, filing your annual financial information on the MSRB's website. If there's any material events in terms of rating changes, or if you enter into some other debt obligations that maybe are outside of a bond issue. So we monitor all that, make sure that you're in compliance, because if you're not, it's going to be a laborious process and something that we don't want to have to deal with. Not that it doesn't happen, but it happens from time to time. But if we can avoid it, we do. And then, of course, from the city's perspective is the investment of bond proceeds. If applicable means basically, if you already spent the $5 million and you're just reimbursing yourself, then there's not really a lot of consideration that goes into the investment of that because you're reimbursing yourself. But if you're, issuing today for a 2-year project, making sure that you fit the requirements that are necessary in terms of pay downs, in terms of using proceeds in a particular in a particular ratio in terms of, in the first 6 months you have to use a certain percentage. The next year you have to use a certain percentage. Or you could be subject to arbitrage in terms of you borrowed at 2%, you're investing at 4%. Of course, these numbers aren't true right now. But if you don't make those particular pay down requirements, then you could be subject to have to pay that money back to the federal government. So that's obviously something that has to be considered as well. And that's more unusual in Connecticut, but it's just something to keep an eye on. Now, more specific to the city, unless anyone has any questions on all that fun stuff we just talked about. There's a lot of information, and I know it's very exciting. But now we have more important city of Norwich specific items, and we can just see here, kind of pulling together what we just talked about a little bit, is we sold last on November 19th of 2019. The bonds were dated December 5th. And the last maturity was August of 2039. So it was a 20-year bond issue, pretty straightforward. In terms of how we look at deals, pretty plain vanilla. It's a good rating. It's a 20-year issue. It's the principal structure was pretty level. So we, as you can see there, that's the actual screen from the results. And you have Piper Jaffray that won the issue at a 2.33. And you can see there was 6 bids, Robert Baird, Morgan Stanley, all, 233, 235, 235, 241, and Rosie was a little bit off with a 257. But on that given day, that was the lowest possible rate you could have possibly gotten because it went out to everybody, they put the bid in. And historically speaking, whenever we're in the low 2s, that's about as low a rate as we have ever seen and we may ever see, unless, something really dramatic continues with this low rate environment. We've only done a couple of deals in the 20 years that I've been doing this in Connecticut under 2% on a 20-year issue. So very, very strong, very low rates. And you can see just a couple of the items that we put in this issue. Public safety equipment, infrastructure program, bonds, and Dodge Stadium had some proceeds in there, stuff that I'm sure you guys are pretty familiar with. So that's the most recent issuance we did. Just in terms of interest rate data, we just talked about the 233 being a really strong rate, and you can look, without really even knowing too much of what's going on with these charts, you can just see the arrows pointing in the down direction. And that basically shows that, historically speaking, we're in a very low rate interest rate environment. The chart on the left is the 10-year Treasury rate, which everybody sees, daily. You can pull it up on Yahoo Finance all the time. I think today it's like a 150 something. The red line below it is the tax-exempt rate. That's kind of like a 10-year Treasury. It's a compilation of 20 securities that Thomson Financial tracks, and it just gives you an idea of where tax-exempt rates are. Just on that one yield, and you can see there should always be a gap since one's a tax-exempt yield, one's a taxable yield. So if you're paying taxes on the 10-year Treasury, you should have a lower rate if you're not paying taxes on the tax exempt. So that's just an indication of rates where you can see from the last 5 years, roughly. The yield curve on the left, on the right rather, has the 1 year out to the 30-year. And it's an ascending curve as usual, but you can see a year ago is that green line, and all the lines below it were either a month ago, 2 months ago, or current. So rates have moved down quite dramatically in the last year. So it was a pretty good time to borrow, as it turned out, which is nice. Now, in terms of the city's credit rating, what we did was, we went through the process with S&P, obviously, and we got the AA rating. And there was a lot of positive things that came out of that. I think there's more positives than there are negatives when it comes to Norwich going forward. So we're excited about that, and potentially, looking ahead 1 or 2 years, there might be some positive pressure to maybe get that up to a AA plus. But what we did here is just to give you sort of a little illustration of where you fall in with the rest of the AAs in Connecticut. This is the entire list of AAs from S&P, and you can see the population. There's definitely a few smaller towns, there's a few bigger towns, but this is the total list. You can see it's from Connecticut's fiscal indicators that they put out. So we compile this data, and what we do is we just try to make it easy for the viewer, and we use these charts with the rating agencies, we use them with councils and Board of Finances and stuff, just to show kind of quickly and easily where some of the weaknesses are and where some of the strengths might be. And we try to cover, the finances and debt and some of the economic numbers as well. So it's kind of interesting. If you look at this is total fund balance. So your 6/30/19 fund balance as a percentage of revenues, which is obviously a very important metric that's used. And you can see Norwich is kind of right in the middle there. On any of these charts, the further right is better. So just to keep that in mind. And when we get to debt, it kind of flip-flops, but it's still better to be right. So you can see right there, Norwich kind of in there with Wyndham and New Hartford, and right at about, I guess, 11%. So a little under the state median, but right there. So not too bad, not too bad.
If I may.
Yeah.
We were to the right more until the last 2 years when we've had to appropriate from the fund balance
Right.
to appropriate to the Board of Education
Right.
Line items. We were probably closer to 14%,
Yeah.
15%.
Yep.
So it's taken a little bit of a hit the last couple of years.
Yeah, no, agreed. And, the comparison is like a snapshot in time. The trend also is important. And so if the trend is climbing and you're getting to this point and it looks like it's going to continue, then you can get some extra credit for that. If it's going the other direction, it actually hurts you in a couple of spots, maybe more than it necessarily should, but just the way that their metrics work and the way that their analysis work. But it's important to note that, there's, reasons, and whether it's Board of Ed or litigation that came up, or the state pulled the rug out from under you mid-year and you had to use some fund balance. I mean, these things happen, and it's life and it's reality. But at the end of the day, these rating agencies have their box. They need to fill out and check all those things out, and wherever you fall, outside of a little bit of subjectivity that they have in terms of overriding certain factors, it's usually pretty much right on where you think it might be. So total fund balance is very important. The next slide is unassigned fund balance, which is also obviously very important because it's still the fund balance metric. And you can see here, because most of your fund balance is unassigned, while it was a little further left on the total fund balance chart, it's further to the right, which is good, obviously. So you're almost at 11%, on the higher side. And obviously, as that continues potentially to grow, that does nothing but put positive pressure on the rating as well. The next chart is equalized net taxable grand list per capita. It's one of the economic factors that they look at. It's equalized is the state number that they provide when they have that crazy formula that nobody could explain, but it tries to put everyone sort of on the similar reval schedule so that it's comparable data, and the rating agencies tend to look at that. And in this particular one, a little bit on the wrong end of that one. Part of the reason why I think the rating is where it is economic driven. And John, we were on that call, and they talked a lot about the economy, and I have some notes later on. But there's some things that you can control somewhat more easily. Fund balance, even though it's not easy because you have to raise taxes, but fund balance is more controllable. Things like the financial management assessment, which have to do with what policies you have adopted and how often you report financial data to the council, and those kinds of things you can help bolster. Certain things you really can't bolster very, very much from one year to the next. Over time you can, and I think going forward, there was a ton of great information and progress on the economic side of things that really, I think, resonated with the rating agency. But some of those things have to come to fruition, and then they need to see how that potentially impacts your grand list going forward before they can actually make a move to the upside. So that's grand list per capita income, again, kind of on the lower end of the spectrum here. Not all the way over, but again, kind of closer to the left. Okay. And then now we move to debt, and you have a similar situation where now you still want to be right, because right means you have less debt, and obviously you're not quite as leveraged. This is debt burden, so it's overall net debt, so basically the par of what you have outstanding to your grand list as a percentage. And see Norwich right here is about 2%. Again, right in the mix there. I think at 3% is when you move into the next individual category with S&P. Because what they do is they'll say fund balance, debt, and debt per capita and all these different ratios. And if you're within a certain range, you get like the top credit. And if you're the next notch down, you get less credit, and it keeps going there, and then they compile everything. But at 2%, you're right, kind of where you need to be. Okay. Then you look at debt service as a percentage of the operating expenditures, the budget, and you can see definitely on the low side, which is good in this particular case, under 4%. So that's not much of a concern. That's a good one. Then we look at overall net debt per capita, another metric that they use, and you're on the lower side again. You're not super highly leveraged, so it's not like debt is the problem that's keeping the city from getting a higher rating. And you can see by these charts on that. Unemployment rate right in the middle, based on whatever data they used in OPM, but you're right at that sort of average for that, so that's not really too much of a concern. This is a kind of an interesting slide. There's a lot of words, but it has a lot of good information. And it's really, these are, and you've probably already flipped through and maybe looked at it, but this is straight from the rating report. So, in the bold, there's like would be the paragraph headings for that particular criteria. So you start off with strong management, which is excellent, and good financial policies. That's the second highest rating you can have. There's strong, there's good, adequate, and vulnerable for the financial management assessment, and that has to do with not necessarily how good is John at being a city manager or Josh at being a finance director, but it's sort of they try to take it and say, okay, we know that the folks that are sitting there have experience and are doing a great job, but also, is there a fund balance policy, a debt policy? Is there do you report monthly to the board with different financial reporting, just to make sure that all the things that management should be doing, that they can feel pretty comfortable that if it's a mayor and that mayor is gone, or if there's a new town manager, that the city will still be run the same way because there are policies that are in place and have been codified. So that's very good right there with that strong management. Obviously, a sticking point was the economy. They reference weak economy, but saying that there are improving grand list projections and a steadying job market going forward. I think this kind of the region is sort of the MSA that you're in is on the weaker side for Connecticut, and that has definitely held down the rating a little bit. We tried in a rating call to unearth every development project going on, how much it's going to impact, all these great things. And while I think that it did stick with them and that they did hear us, they need to see some of those results. So that's what we're going to hopefully try to do as things do progress over the course of the next rating call and beyond in the next couple of years. Adequate budgetary performance is really, to John's point about having to use some fund balance for the Board of Ed and how that works through your financials. It basically just says, your year-end surplus or deficit is how they term it, how that falls in terms of ratios. obviously that is going to not be very strong if it's been, slight reductions in the fund balance. Then we look at strong, I mentioned strong debt and contingent liability profile, talking about, the percentage of budget that the debt service uses, looking at net direct debt as a percentage of overall revenue, and to market value, and your 53% of your bonds are paid in 10 years, just slightly lower than what they like to see, but it's still pretty much in the ballpark. You have a strong label on it, so that's obviously good. The other probably sticking point that we see going forward is the pension and OPEB situation, which I see a lot of you nodding your head because you probably heard this before, but total contributions at like 10% of the budget is definitely on the higher side. The overall pension funding ratio is 60% plus or minus. They like to see, higher, 70, 80%, obviously. So that's something that's going to be a drag on the rating a little bit going forward. And obviously the overall size is on the higher side at $100 million for the pension and about $40 million for OPEB. They lump OPEB in there too. The pension is more important. It has been. It's gotten the headlines over the last decade, 2 decades, state governments, nationwide. OPEB is also very important, but pensions have just taken sort of a front seat with respect to that. Strong budgetary flexibility. We talked about fund balance. They actually look at available fund balance, which is unassigned plus assigned, which in your case is very similar to the same because there's not a lot of committed or restricted. And you can see, they say it's strong. You have 11.4%, which is great in 18. Strong liquidity, which is related to cash, to expenditures, and some different ratios there. But that's, again, very strong, so there's no issue there. And strong institutional framework, which is the same for every single issuer in Connecticut. Because you're in Connecticut, and you said, all right, based on your autonomy and things like that, you get a strong for that. It used to be very strong, but Connecticut's dragging down everybody with their fiscal problems, so they notched that down to a strong. But that's kind of it, your rating in a nutshell of the process, the credit. Did a lot of talking.
We only got a minute. Just a quick question.
Yeah.
We're supposed to start in a minute, but at debt service levels that we carry right now, how do they compare to other communities our size?
The debt service, like the carrying charge we talked about, as far as debt to budget, or just overall debt? Debt to budget?
Debt to budget.
It's on the lower side. It's on the lower, and that's, I showed you the graph here, but this is all to the double A's. This one right here. Like that's a double A category. But you're in very good position there with respect to any rating category. In fact, like with S&P, you get full credit for anything as long as you're under 8%. You get full. It kind of goes 8 to 15, 15. Then it goes into. But relatively speaking, that's a strength at the moment. So,
Thanks.
so you're in good shape there.
Thank
And
you.
there are some unique things with the city, with the NPU and that kind of thing. So there's a lot of other things that go into the rating too, but these are just sort of like the easier ones to understand and to show physically. So.
Thank you. Anyone got a quick one? Quick question? Thank you very much.
All right.
Appreciate it.
Appreciate it. Thanks for having me out. And enjoy the evening. Stay healthy.